Daily Market Wrap, Tuesday the 20th of August. Jack, quite a lot of movement going on last night, mainly on the back of some of these debt buybacks coming out of the US.
Yeah.
Tell us a bit about that.
That was the massive announcement that has moved markets quite dramatically overnight, was US Treasury Secretary Scott Bessent announcing the US are doubling their debt buybacks from $2 billion to $4 billion. This is in response to the rapidly growing long-term yield curves at the moment, which have hit 19-year highs. So what this move is designed to do is bring down those yield curves, which were increasing borrowing costs, increasing debt obligations. So the move is basically the US is buying those long-term bonds and issuing short-term bonds to fund it. So this isn't changing the amount of debt in the market, but it's just changing the structure of that debt. So bonds are heavily supply and demand. When the US is buying those long-term bonds, there's less supply, which drops down the yields, but the yields on the short-term bonds will increase as there's more supply of them now.
And the FOMC minutes coming out. Just give us a bit of background on these, what they are and how they affect the markets.
Yeah, so these are the meeting minutes from the Fed Reserve's interest rate meeting that we saw a couple of weeks ago, with the Fed moving away from giving any forward guidance. This is what the market's now looking forward to find the sentiment and what the Fed's looking to do moving forward. The officials in this meeting were quite hawkish, meaning they're looking to raise rates rather than cut rates. And again, inflation was the key sticking point. Normally this would be really positive for the US dollar, but it was heavily outweighed by that bond movement, which really dragged down the dollar.
And some tariffs over in Canada. So Trump announcing to putting a pause on the 50% tariffs.
Yeah, quite unprecedented. Who would believe it that Trump's backed out of a promise he's made regarding tariffs? So yeah, he's paused the impending tariffs on Canada until Friday. Again, he's just posturing to try and get the best trade deal possible with Canada. So he's asking for basically Canada to not retaliate with their own tariffs and ease up on things like alcohol, dairy and auto exports. So yeah, they're sort of going back and forth between those. Obviously going to have a big impact on the Canadian dollar.
And coming out today, we've got the Oz unemployment rate. So forecast to hold at 4.4%. Any expected changes there, or any big moves expected if that differs? Yeah,
as we have discussed on the release of the news, that there's unlikely to be much movement in the Aussie dollar. Where we'll see movement is where it differs from what's been forecast and predicted. So any drop in unemployment, so any fall in unemployment will be positive for the dollar, as that means more people are spending in the economy, which drives up inflation. Whereas any rise in the unemployment rate means less people are working, less people are earning a wage, less money flowing into the economy. So the bigger the surprise, the bigger the move in AUD. But if it comes out as a hold, there won't be too much change.
Okay. And some PMI data coming out from Europe. What is the PMI data and what does it impact?
Yeah, so this will all flow out tomorrow. So today's big one is the Oz unemployment. Tomorrow we'll see PMI from across the globe, Purchasing Managers Index, and it's basically looking at private business sector activity. We've talked about the 50 mark being the baseline. Anything above 50 shows an expansion in business activity. Anything below 50 is a contraction or a shrinking of it. And the PMI will look at both manufacturing sectors and service sectors. And the European economies normally give out a composite which sort of combines those two figures and allows you to measure PMIs across regions.
And the big moves on the back of those announcements yesterday. So starting off with gold, so up just over 4%, which is a huge move for gold, even in the context of some of the recent volatility. This is a pretty big one.
Yeah, massive moves. We always harp on about gold being a non-yielding asset. So when US Treasury yields fall down, there's less opportunity cost missed by holding on gold, so gold becomes more attractive. So that's really pushed up this price. The US dollar also fell off because of that. So again, a lot of factors playing into gold's favour.
Bitcoin. So Bitcoin's been fairly quiet for a while, but a 7% jump just on the back of that announcement.
Yeah, that announcement was the huge catalyst for Bitcoin and other cryptos. We've also seen they've been sort of coiled recently. There's been talk about a short squeeze on it, so a lot of traders holding short positions on Bitcoin. So when Treasury catalyst sparked that positive move, people holding short positions are forced to liquidate, which only exacerbates the positive move, which is why we can see such a big jump. Trump's also pushing to pass a bill through US Congress, which will be supportive of these big crypto companies as well. So yeah, again, multiple factors are driving this move.
And the euro dollar, almost a 1% move. Obviously, a lot smaller than something like Bitcoin, but a 1% move on the euro dollar is very large in comparison to a standard sort of day.
Yeah, definitely a big move in forex terms. We saw the US dollar fall against all the G10 currencies. Again, lower yields in America make the US dollar less attractive for investors as they're getting less returns by holding US dollars. So yeah, this drove up multiple crosses against it. The euro dollar being one of the most traded currencies in the world.
And the S&P 500, so it's been coming off for a few days and has spiked up again with the rest of the equities.
Yeah, you can just see the impacts of these moves and the volatility it creates in equities. So yeah, most of the indexes will have experienced a bit of volatility overnight.
And the chart of the day, Ethereum. So you spoke a little bit about cryptos in general. Why do we see Ethereum, more than others spiking up?
Yeah, so spoke about Bitcoin and Ethereum's got the same sort of conditions applying to it. So I talked about that coiled. It's been coiling for about 6 weeks now. That triangle shows what that coiling actually means, which is just a slow compression over time. Think of it like a spring compressing down. This Treasury move sort of cut that spring, pushed it up. The short squeeze obviously gave it further support, which is why we see such a massive bounce up. It's pushed through that 200-day moving average, which is a really key resistance point, which was around 2,000. So the price is sitting at 22.50 at the moment. So the next price, if this positive momentum continues, will be 2,400, which is where we saw it sitting pretty comfortably around April.
And then on to the article of the day. So just on that Treasury buyback.
Yeah, we can see how much this buyback affected markets. So it'd be a really crucial article to read just to understand what's actually happened and why it matters.
Any questions from you guys? Yeah, Karen.
When a move like this happens, how long does the impact usually last? Is it a 1 month? Is it a 6 month? Or until somebody does something major?
I mean, the immediate impact, as you can see on the charts, is pretty quick. It would just depend on exactly what it is, but the markets are pretty reactive to it, so it's typically not as longer term. I mean, depending on, like I said, what the actual announcement is and what the long-term effects are.
I think definitely in recent years, the market's becoming even more reactive to stuff like this. I think since COVID has been a big catalyst for that. Previously the market was able to filter out noise and sort of sentiment, but everything has shifted to just trading on sentiment now, and we're seeing these moves exacerbated and probably shifting from a long-term mindset to a short-term mindset. Given everything going on in the globe, it's probably something out of the Middle East will shift it again and flip it on its head. But we can see over the last few months, anecdotally, the Fed has been driving the market. But the Fed just released some news and no one really batted an eye because they were focused on on the bonds and the bond buyback. So yeah, probably leaning towards a shorter term mindset. The US have got midterms coming up in November, so this move is unlikely to have long-term ramifications on the bond market. It's more seen as a saving face to try and curry favour at these midterms.
Yeah, I think technology as well, and will only get better at capturing these sorts of movements and pricing everything in very, very quickly, even for some of these announcements that are, unusual or, react to the markets that big.
Thank you, everyone.
Thanks, guys.